I actually started writing in college for the local, school newspaper, the Villanovan, and I wrote for some small community newspapers, Suburban Wayne Times, and I got my master's, and I had it in my mind that I wanted to go to Washington, D.C. and, become the next Woodward Bernstein and, be an investigative reporter. And I went down there for a couple of months and just hated it. I thought the place was horrible. I mean, it was just no sense of integrity or anything like that. It was a lot of compromise of principles. And I didn't think it was going to be my cup of tea. And so I came back to Villanova and asked the publishing company, the publisher of the paper, I said, can I have a job? And I'd like to do some more writing for you. And he said, well, we can't afford to pay you, but if you go out and sell quarter page ads for our newspaper, you can have a piece of that for your salary. And then maybe we can let you write a column from time to time. So, I walked up and down the main line outside of Philadelphia, Route 30, and I knocked on doors. And one day I came across something called Legg Mason Woodwalker, members of the New York Stock Exchange. I had no idea what that meant. I thought maybe it was a law firm or an accounting firm or something like that. And this was 1984. Bull market had just begun in 1982. And I walked in, I said, I'm Robert Hagstrom. I'd like to see if you guys like to buy a quarter page ad in the newspaper. They took me back and introduced me to the manager. He said, what are you up to? I said, quarter page ad in the newspaper. What do you think? He says, no, would you like to be a stockbroker? I said, well, I hadn't really thought about that. And, but quickly in my mind, I was dating a woman that I hoped would be my wife. And I thought maybe she'd be a little more impressed with a stockbroker than a quarter page ad salesman in a newspaper. So I took the job. And actually, we had to go through training. You had to get your license, go through training in 3 weeks in Baltimore. And I thought I just made a terrible mistake. We looked at value line investment surveys and income statements and balance sheet. I'd never had a course in accounting or economics. And I thought I just made a horrible mistake. I was going to resign. It was Thursday night of the third week. And I had it in my mind I was going to resign the next day and apologize for wasting their time and money. And they hand us a copy of the 1983 Berkshire Hathaway annual report, photocopy, and which I'd never heard of, written by a guy named Warren Buffett, which I had never heard of. And we were asked to go back to our hotel room, read, and come back the next morning to discuss. So I went to the hotel room and plopped down and opened up the pages and was immediately depressed because there was no tables, no graphs, no pictures. It was 20 pages of typewritten words. And it really was, as I started to read it, it really was the proverbial, light bulb goes off epiphany, and what happened, guys, was that you go back and look at it. Warren spent his time introducing you to Rose Blumpkin, who ran the Nebraska Furniture Mart, and Chuck Huggins, who ran See's Candies, and on down the line. And so it all of a sudden started to go, the light bulb went off and said, oh, all these, the value line and all these numbers and price earnings ratios and book value, these are actually companies we're talking about here. And they have products and services and they're run by people. And when I kind of connected to that, everything made sense to me. And so I went back to Bryn Mawr, Pennsylvania, down the road from Villanova University, and went into production. And after a few years, my manager came up to me and he said, Robert, you're going to starve to death if you don't ever sell anything. And I said, well, that's not the way it works. I said, this Buffett thing, we own good companies, and if the companies are doing the right things and, reinvesting in themselves, we're going to make a lot of money. And you could see the portfolios were going up. He says, yeah, but you only make a living if you buy and sell, and all you're doing is buying and holding. You're on half rations, so you better get to it.
Who said this?
I'm sorry?
Who said this?
This was the manager of the brokerage firm that, when I went and asked him, for a quarter page ad, same guy. And so I left, went to the buy side, got my CFA, and ended up writing the Warren Buffett Way. Started writing the Warren Buffett Way in 1993, and it was published the following year in 1994.
So he was telling you basically that you can't make money if you don't sell.
Well, you guys probably don't remember, but brokers back in the 1980s and late 70s and early 80s, could only make a paycheck through commission to buy something, commission to sell something. There were no fee-based products. I think E.F. Hutton came up with the first wrap account that charged a fee, and that wasn't until the late 80s. So, the only way that brokers could make a living was to transact. You had to transact. You had to buy and sell things. And the more that you bought and sold, the more money you made. And so there was a lot of people were trading every single day. And I was not trading every single day. I would buy something and hang on to it. So the incentive, the incentive program of being a broker in the early days did not favor the Warren Buffett approach. You couldn't make a good living doing that. But then I went to the buy side and joined an investment partnership, and that's where I wrote the Warren Buffett Way. So I got paid based on assets, not how many times I bought and sold something.
Your answer. So, current valuations. What do you think?
Well, the market's not cheap by a lot of historical measures, but the one thing that you have to keep in mind is, price earnings ratios are not valuation. They're just, the market's expectations, right? They're kind of, it's kind of the market's voting of how they feel. High price earnings ratios are kind of the market's optimistic about things, and low price earnings ratio, the market's pessimistic. But whether it's undervalued or overvalued, it's not a function of price earnings ratio. It's about cash, right? And we know very well now from John Burr Williams, and Warren wrote about this in 1992, but it's all about the cash. And then what we also know, it's about the return on capital. And so there's two parts that you've got to figure out, which is where's the cash and where's the cash going to grow, and what do you discount it at? But the valuations can change based upon returns on capital. And so if you kind of look at the aggregate economic returns of the S&P 500, you've seen a steady increase in return on capital and return on equity. In the 1980s, I guess the average return on equity was around 15%, 10 to 15%. And I think I remember Warren's one time saying, that's about as high as it ever gets. But as the complexion of the market has changed, a Darwinian kind of view that as we added more technology companies, healthcare companies, and there were less manufacturing, less energy, less, capital intensive businesses, the complexion of the market changed, and we got higher returns on capital. So it may be that, at 22 times forward earnings, the market looks a little bit richer on its expectations based upon an average that was more like 17 times, 16 times, with where interest rates are and inflation. But when you look at the returns on capital of NVIDIA at 100% return on capital, Apple 100% return on capital, Google 50% return on capital, Meta, 50, 60% return on capital, go down the list. The value of those multiples is certainly higher based upon higher returns on capital. So we're kind of left with a conundrum, which is, historically speaking, it looks a little rich, but the data is non-stationary. Remember, if the data is non-stationary, that, just using simple averages are not going to give you thoughtful answers. You've got to put it all into context. And the context is this, that the market, kind of looks expensive, but it may be more justifiable because the returns on capital for these businesses are, 2, 3, 4, 5 times, what the average was, 5, 10, and 20 years ago. So you pay up for those returns on capital, and they generate so much cash. I mean, it's just, and the margins are so high. So those businesses at the top of the list are very, very attractive businesses. And, I don't know if you want to jump ahead, but I'm sick and tired of everybody telling me this looks like 1999, and this is a tech bubble. Well, I managed money with Bill Miller at Lake Mason in 1999. I ran a growth portfolio. He ran the famous Value Trust. And, we were, we didn't own it, but you could see Cisco was 101 times forward earnings. Microsoft was 60 times forward earnings. So, today, what is NVIDIA? 35, 40 times. So, Microsoft 30 times. And so the multiples today for these great businesses, and they are great businesses, are a fraction of what they were in 1999. The only similarity is that late 1990s, you had technology stocks go to the top of the list, and they appreciated quite a lot. Today you have, technology at the top of the list, and they've appreciated quite a lot. But the economic returns are totally different than the tech bubble in 1999.
Since 2018, rebounds have been less than 6 months in duration. What do you think is the reason for this? Do you think there's faster information? Do you think it's Darwinian, like you were saying earlier, or do you think we just haven't experienced something like that warrants a longer drawdown?
Yeah, that's a very good question. There was actually I don't know if you guys know. I was just reading it last night. There was a guy named Rick Ryder, who's the CIO at BlackRock for their fixed income portfolio, and he wrote an op-ed piece in the Financial Times yesterday. And his point was that, with all the headline risks that we've had, this year and even the past couple of years, it really has been quite amazing that other than 2020 when we had a sell-off in COVID. Now, 2022 was pretty nasty. That was a kind of a year-long bear market. But kind of since then, the market's kind of hung in there pretty well, despite all the headline risk. I've been kind of surprised that the market didn't discount the headline risk of Middle East wars and, everything that was going on, the tariffs. We had a drawdown in the tariffs during the liberation period, but very, very short-lived. And his point was that he felt that the market is probably signaling that the economy is much stronger than most people think. I mean, if you think about it, what are we, 69, 70% service, which is, much more sustainable, good business, not so deeply cyclical like the capital intensive businesses are. Balance sheets look okay, unemployment is low. So, you could take headline risk and you could take, kind of body shots because the economy perhaps is much stronger than it has been in the past. The other thing is that people point out that the last two bear markets that we have were relatively short. I mean, months, not years, and some people might have just come around to the idea that when you get into a bear market, it doesn't last that long. So they buy the dips. If it gets cheaper, they'll just come in and buy the dips. So, there's a lot of cross currents in the market right now. The thing that's kind of fun to noodle on is just the changing structure of markets, right? If you think about strategies being species, right? In my day, the biggest species or the largest number of strategies out there were long only. Well, now long only is probably in the minority. There's hedge funds, there's algorithmic trading, there's a lot of things going on today that move stock prices around that weren't moving stock prices around 20 years ago. So being a long only guy, we don't move the markets like we used to when Peter Lynch was there and even Bill Millers and stuff like that. Today it's Citadel, Jane Street, you go down the list. These guys are moving markets, and you can see it on the screen. You'll look at a screen and 9:30 and a fraction, it turns instantly green or instantly red and changes from day to day. It's as if the market has no memory whatsoever. And so that's not me, that's not a trust company or a chartered financial planner or, whatever the case may be, certified financial planner. But, those are the players in there that are doing algorithmic trading, and that they bang around quite a lot. And so it's really hard to read the tea leaves in markets today. There's just so many cross currents. It's hard to wrap your hands around it.
Great. That kind of ties into my next question. With the market's performance so concentrated in a few mega cap stocks, do you see this as a systemic risk or as a major opportunity for contrarians? Where are you finding value in parts of the market that are being ignored?
Well, in my mind, it's only a bubble if the prices don't, reflect some sense of value, the valuation of these businesses, right? And you can get stretched, as we did in 1999. Today, though, the valuation of the Mag 7 ex Tesla, I don't own Tesla. I think Tesla is a different animal. But if you took Tesla out and you had the Magnificent Six, the valuation work on that would tell you this is not a bubble. So what is different today are two things. One is that we've never had the largest companies in the world also were the fastest growing companies in the world. Never seen that before. And to the degree that as they grew, not only did they get bigger, but as they got bigger, they even grew faster. And so there's an economist by the guy named, I can't remember it, just I'll think of it in a second. He was out at the Santa Fe Institute, and he wrote a book called Increasing Returns Economics, and Brian Arthur's his name. And he pointed out in the digital world, unlike the manufacturing brick and mortar world, in the digital world, the networks are the new moats, and these networks are very rapidly growing, low capital intensive, and the bigger they get, the more powerful they get. The more powerful they get, the bigger they get. And so it's a self-fulfilling prophecy that networks values go up the bigger they get. And so what we're seeing is actually very sensible what the market is doing. It's pricing in some of these digital networks. And you've never seen trillion-dollar businesses that grow this fast. I mean, we never had trillion-dollar businesses. I mean, if you can't even go back to when they were hundreds of billions of dollars, you've never seen businesses of this size grow this fast. And it's because we're not in a brick and mortar world, which has diminishing returns economics over time. In the digital world, it's increasing economics. And so it makes perfect sense to me that where the stocks are. And so they should have gone to the top of the list. They were the fastest growing. They grow earnings at the fastest rate. They have the highest returns on invested capital. So, to say that they don't justify or they don't deserve to be at the top is not a very smart thing to say, because the fundamentals, the economic fundamentals justify it completely. So we did, it was 2024, and we did a study. Everybody was beaten up on the Mag 7, and they've been beaten up on it since the end of 22, right? And you get into 23 and everybody just lost their mind, and we got AI and stuff like that. But if you look at, I think it was 2024 through 2025, we looked at the EPS growth of the Magnificent Seven, and the earnings and we looked at earnings per share and price appreciation. And so what we noticed was, whether it was NVIDIA, whether it was, Apple, whether it was Meta, it didn't matter. Their prices went up not as fast as their earnings per share went up. So these companies were going up, 30, 40, 50%. In the case of NVIDIA, going up. NVIDIA's earnings multiple actually declined over that period in 24, going in there, because its earnings were growing faster than its multiple. So in my mind, they're at the top because they economically deserve to be at the top. They grew earnings the fastest. Their earnings went up faster than their price did. They have the best returns on capital, and they're the fastest growing, but the earnings just came right along. So all of this makes perfect sense to me. Now, if you say to me, this could end badly, well, yeah, if AI is let's say AI is just going to be a bottle rocket, it's going to fizzle out in the next year or two, then yeah, that's a bubble, right? That could be a problem, and they'd have to reprice that. But if you think AI is more of what I call a deep space rocket that's going to last for the next 3, 5, 10 years, which in my opinion probably is what we're looking at, then these stocks, are not overvalued. They deserve to be at the top of the page. And the only thing that freaks everybody out is every time a stock gets to the top of the page, they think it's a bubble and it's going to get cut in half. Well, thus far, that's not been true.
Perfect. Thank you. Is there any other pockets within the market that you think are being ignored? Maybe like certain industries, or?
Yeah. Today it's kind of commonplace. The one thing that we did in the beginning of 2024 is we sold all our services, software as service stocks, SAS stocks, because the more we'd spent time on AI, I kind of struggled with the idea whether AI could disrupt enterprise software. I mean, it got to the point, you could see this, Adobe was, I think Adobe's done nothing for over a year and a half. When AI can start to make videos and they can do PowerPoint presentations and stuff like that, you don't have to pay Adobe any money, right? AI can do it for you. So their moat, the enterprise software market's moat, was starting to fracture a little bit. One of the highest, great companies, but it's just AI is going to impact them a little bit. One of the biggest expenses that companies have is, customer, retention software, CRMs, and Salesforce, right? And Salesforce is a subscription business, and they try to raise the prices on you every year, and everybody's got to have a license and stuff like that. Well, it's not going to be hard for AI to figure out exactly what Salesforce does and do its own software. So we knew that gig was up. I mean, that the market was going to finally figure out that the growth rates of these were going to slow, and that there was a competitive threat from AI to do basically the same thing in software. The one thing that we did realize, though, some of this work was at Santa Fe Institute and other places in New Mexico, was that we had never seen the growth of electricity begin to accelerate at a level. And we could track, electricity post-World War II, kind of grew at a 2% rate, no big deal. But when you added crypto, then you added electric vehicles, and then you added AI, you got this parabolic movement in demand of electricity over supply. And anytime you see an elbow, take off like this, and supply is growing at 2% and demand's growing at 5 to 6%, that excess return is huge. And so when we sold our SAS stocks, or services software stocks, we bought GE Vernova, which does electric utility. They do gas fired utilities, power plants. They do the medium sized nuclear reactors. We thought that would be a good place. We bought Caterpillar, not because of the shovels, but really because they're the world's largest provider of natural gas generators. Every one of the data centers has to have a natural gas generators, and then other hospitals and commercial buildings and everything like that, because the grid is so fragile. Everybody was loading up on natural gas generators. We bought Train Technologies, a company that's probably number one in the world with HVAC, but they also have a private equity investment, or a private investment. They're the largest investor in a company called Liquid Stack. That's a liquid coolant. They dropped the Dell servers right into this liquid coolant. So we gravitated towards the areas of where the end users of these utilities would have to spend money. And that's been a home run for us. We bought LNG, Cheniere Energy, nat gas. Nat gas is probably the way that this thing goes. I mean, it'll be everything: nuclear, it'll be wind, it'll be solar, despite the administration's pushback on that. Unfortunately, it'll be a little bit of coal, but nat gas is huge. So we kind of built a sub category in the portfolio that was what we broadly call an electrification, and put 4, 5, 6 stocks in there, and they've actually just done terrific for us. So, I think that could last 10 years, and it's a global phenomenon. I mean, if you look in Spain, you can see how fragile the grid is there. Anywhere you go, the grid looks like it was built in the 1940s, because it largely was. That's why it looks like it, and not a lot of money has been spent on improving it. Well, now it's going to get improved. It has to, because the demand is just going to be overwhelming, and they're going to have to repair what is old, and they're going to have to make more supply to meet demand. So electrification makes a lot of sense to us.
Great answer. Okay.
This next question is right up, like this is all micro. So you talk a lot in your book, The Warren Buffett Way, about owner's earnings, free cash flow. And you also talked about a lot about return on invested capital. And I'm personally more interested about return on invested capital, and how you categorize the invested capital piece. The return, I think, is just from the operating earnings, right?
Yeah, I mean, with earnings, all very simple. I mean, we don't try to overthink it or something. We just take, we start. GAAP is where you start, not where you end. So we take GAAP, and then we'll reduce GAAP earnings by what we think, or what we discern would be the average annual capital expenditure. So you've got earnings, but you got to put it back into the company, right? So we're trying to figure out what that is. And then you figure out the non-cash charges. So your EPS are being chipped away because of depreciation and amortization. But so you can add back the non-cash charges of amortization and depreciation, but you got to reduce your capital expenditures to get what Buffett calls owner earnings. That's your cash, right? I mean, that's stuff that you can put in your pocket and go home and pay the mortgage and, send your kids to college. That's real cash. That's money. So that's what we try to get to. But you're right. It's return on capital. So, Al Rappaport, who wrote a great book seminal book called Creating Shareholder Value, was the first guy to figure out, or at least to illuminate, companies that earn above the cost of capital increase intrinsic value. Companies that earn below the cost of capital destroy shareholder value. And Michael Mauboussin, who wrote the book Expectations with Al Rappaport, brilliantly kind of went through all this. And so we're very, very conscientious of where our return on capital is. So for equity capital, we just use 10%. That's our opportunity cost of capital. And debt's pretty easy to figure out. That's pretty stated. So we do a weighted average cost of capital. And oftentimes we're earning multiples of that. I mean, we like companies that are 30, 40, and 50% return on capital. So we're way above our cost of capital. So if you're growing cash, you're earning above the cost of capital. The only thing left is sales growth, right? And that's the accelerator. That's the turbocharge. I'm earning cash. I earn above the cost of capital. Then all I want to know is how fast you can go and how long will it last? And if it goes fast and lasts a long period of time, you're making multiples on your investment, multiples.
So just to clarify, you're looking at CapEx, and then are you adding also how much they're paying employees or just CapEx?
I mean, we used to have to go through that with stock options. We clean it up now with stock options. But when you get to GAAP earnings, you've done the electricity, you've done paying the employees, you've done other than stock options. But we can solve for that. You're down to net income. The problem with GAAP earnings is that it doesn't take into consideration capital reinvestments that you have to put back in, and the depreciation and amortization, which is the old GAAP came out at the turn of the century when it was a brick and mortar world, right? Today, intangibles, right? If you look at intangible investments, it's just software development and things of that nature. That's an expense line through the income statement. I would be more comfortable capitalizing, the intangible investments. Michael Maubussin's working on this, which is, put it this way, the price earnings multiples of NVIDIA, Microsoft, and the rest of them are not as high as you think it is because their intangible investings are almost 50%. So if that was capitalized like a brick and mortar world, and not through the expense statement, their multiples might be 20 multiples, not 30 multiples. So you have to think about that.
Awesome. Thank you. My next question is intrinsic value. How you personally measure it, and then other people.
Well, there's no shortage of ways to do it. In the Warren Buffett Way, we just used a Gordon two-stage growth model where we did 10 years at above average growth. And then in year 11, I think we did 5% residual, which is everybody defaults to some idea of nominal growth in the fifth year. And then you discount it 10%. And that gives you the approximation. Now, we have models that, we can do 3-year, 5-year, 7-year, 10-year models. We can do one model that does all those computations within 10 years. We can weight them differently. So, using the Bayesian inferences, we can put maybe that there's a 50% probability it'll grow at this rate for the first 5 years, a X% probability from years 6 and 7. And so you can do that until the cows come home, and you can come up with a lot of things, right? What I find really interesting, and I've been doing it more and more, is what, Charlie Munger said, invert, always invert, which is basically reverse engineer the DDM. So we did this during the, when we went through the de-risking period right after Trump did the Liberation Day and, was basically going to choke off the economy with the tariffs, and the market went off the cliff. I don't know if you remember in the spring, that April 2nd through April 9th, the market was puking stocks. And when you in a de-risking market, then that's what was going on. People were selling risk and buying safety. And so you sell, bonds go up, right? And you sell high beta stocks because they go down the most, and you buy defensive stocks. So what was going up was Coca-Cola and Pepsi and Procter and Gamble and Clorox and on down the list. And what was going off the cliff was NVIDIA and because you were selling high beta, right? Because that goes down the most. And you were buying low beta defensive stocks. So the S&P low volatility index was creaming, the Russell 1000 growth. And it was just absurd. So all I did was just spend the days doing reverse DDMs on the prices of stocks. So, and Coca-Cola is a great company, and it's a backbone of Berkshire Hathaway. But at $70 a share, which is pretty much where it's trading now, if you did a 10% discount rate and looked out 10 years with the 11th year doing a 5% residual, Coca-Cola would have to grow at 19% per year for the next 10 years to justify its current price. Well, if you just looked at the earnings report a couple of days or last week, Coca-Cola grows at 4%. All right. Procter and Gamble basically had to grow at 9% and only grows at 3%. Everybody had to have Walmart. Walmart had to grow at 19%, just like Coca-Cola for 10 years. And Walmart will tell you they can only grow at 5 or 6%. So you could see through the expectations, reverse engineer, that you can get these gaps, in the market. Meta was only discounting 8% growth. Google was indicating 9% growth. I think NVIDIA was discounting 15% growth. So the tech side looked like the expectations for their growth rates were very low based upon what they've been able to achieve. And the market's expectations for the growth rates of the staples, the defensive side of the market, were 20%, which they'd never been able to do before. So just doing that alone, forget the DDM type stuff, just doing that alone, expectations investing, you could just say, look, I think the market's got it wrong. I don't know, you guys know Michael Steinhardt, a great hedge fund manager, and he wrote a book called Bull, but he used to yell at his traders, what do you know that the market doesn't know? Well, the question you should say is, well, what does the market know? Well, if you do an expectations model and you do reverse engineering on your DDM, I can tell you exactly what the market thinks of Coca-Cola. And you could say, well, that looks a little expensive. I don't short stocks, so I can say, well, I'm not buying that because the market says it's going to grow at 19% and it can only grow at 3%. I'll pass. But it says, well, Meta can only grow at 7%. And I go, yeah, but I think it could probably grow between 10 and 20. So, I'll take the over on that one. And so you can adjust the portfolios for things like that. But you can make yourself silly over DDMs. I mean, and I can make any DDM work for you that you want. But as Buffett paraphrases, John Maynard Keynes, who said, I'd rather be approximately right than precisely wrong. And DDM gets you into the game and kind of gives you that's all you have is approximations, and they help you reduce the cone of uncertainty into something that's workable. But after that, I'm looking for more gap between what the market's expectations are and what I think are. If I can arbitrage that gap, that's pretty good for us.
Wow, that's an amazing answer.
That's Michael. Yeah, it's Michael Mauboussin. Let's make sure that we give credit when credit's due. That's Michael Mauboussin and Al Rappaport, and they wrote a book called Expectations in Investing. It's a very good book, and people should read it.
My next question was income statement versus balance sheet. Touch on that if you want quickly.
Yeah, Buffett said something pretty interesting this year at the annual meeting, which he had never seen before, and he'd never said before, and never written before. He said, I always start with the balance sheet first. And I put my pen down. I said, I've been studying you for 30 years, and you've never said that before. But he's absolutely right. If you think about it, the person, if a business owner, the first thing I want to know is, who do I owe money to? How much money do I owe? Is it, to a bank or, to other investors or, the government? I owe taxes. He goes, I always start with balance sheets, trying to figure out where my risk is. Where do I owe money? Where's my downside? I think that's very clever. I wish he would have said it in 1994 when I wrote the book. I could have included it. But I think you start at the balance sheet, which is just give me a quick look at where's my downside risk. And he was talking about derivative exposures in insurance companies and banks too, because it's kind of like being short a stock, and if you're wrong, you get crucified. And sometimes you're in derivative contracts, and if you're on the wrong side of a derivative contract, you might owe a hell of a lot of money that you didn't even program in your mind that you did. So when he was talking about, who do I owe money to, I think it was less about bank debt. It was more about derivative exposure. I'm hedged, and if I'm wrong on my hedge, I'm going to owe a lot of money. So he thought about that. And an income statement, I'm not an accounting major. I mean, it's pretty easy type stuff. I try to keep it as simple as possible. I think we overanalyze. I think we overanalyze the numbers. Not that they shouldn't be analyzed, but we spend too much time on numbers and not enough time, as I said earlier, on competitive strategy. Now, if you're a buy and hold person, competitive strategy is everything. If your turnover ratio is higher and you're looking to do more short-term trading, then all of this, it doesn't make any sense to you, and you're not going to spend any time with it. You shouldn't, because it won't help you in that strategy. But I'm prefacing this for a long-term holder of stocks. Competitive strategy is the holy grail.
Finishing up your career in investing, did you have a best investment that stuck out over the past however many years it's been? And then what's the longest investment that you've held? You mentioned there was an 11-year hold,
Yeah.
but I don't know if there was one longer than that.
Yeah, 11 years is probably, when I was with Bill, I kept things for 5 years. Just looking through my last year's annual report. Okay, these are stocks that we've held. So the portfolio began in 2014, June of 2014. And these are stocks that I bought on the very first day that I still owe today. Apple, MasterCard, Louis Vuitton, BlackRock, and Brookfield Corp. And those are 5-6 names right there. Stocks that we've owned now for 9 years, Alphabet, for 7-8 years, Amazon. We did the IPO on Amazon with Bill when Jeff came out. When Bill shut down Legg Mason Capital Management, there was a period about a year before I joined Equity Compass, and I wanted to buy Amazon, but talk about a psychology misstep, a bias. I mean, I just couldn't pay because Amazon was so much higher than what I had sold it for 2 years earlier. I refused to buy it until I realized that was very stupid. And so I bought Amazon back in 2018. We've had Richemont since 2019. So, we try to keep stocks, as long as they're doing their job and they're earning good money and they're compounding, they'll be fine. Apple we bought a year before Warren did. That was the only time I beat him to the punch. But you could buy Apple, and the market was discounting no growth, and that was just stupid. I mean, if you did you could kind of figure out, and there's work that you can do is how much are they discounting current earnings versus growth of earnings, and they were discounting no growth of earnings in Apple, and that just made no sense. And of course, the service side of the business exploded and stuff like that. Apple's in a little lull now. We trimmed back the position at the beginning of the year. We didn't sell it down. I think it was 7-8% of the portfolio. Now it's about 4% of the portfolio. We'll ride it through this AI cycle and see what happens. So I mean, we like owning companies for a long period of time. We do.
Nice. That's awesome. Yeah, I think Louis Vuitton had earnings yesterday or this morning. But I guess,
yeah, they're fine. I mean, they go through. I mean, people have told me to sell Louis Vuitton and Richemont about 8 times over the last. It's always a cycle, right? They're not going to buy handbags anymore, or they're not going to buy Cartier anymore. They go that the economy is slowing, and you see it all the time. But Maslow's hierarchy of needs. Fashion goods is like number 3. You want water, you want food, you want household products, and then you want to dress better, and you want fashion goods. That's been going on for hundreds of years. And I don't think there's any reason to think that that'll change now. As a matter of fact, I think Louis Vuitton is probably the cheapest I've seen it in some time. So, I think that's worth it. Yeah.
That was the reason I brought it up. I think they've been going down for quite a while now. And that CEOs are making some comments about the share prices. Do you add more to a position that you've been holding for so long like that? Or do you just...
Yeah, sure. Yeah. I mean, the stock's down 16%, so it was, $1.60. At the beginning of the year. Now it's 101. I mean, that, and then that's it's very interesting here. Very, very interesting stock here. So we had sold, our turnover ratio is higher than our name ratio turnover. So like I said, we have some stocks in here, been here for a long period of time. Their weights have changed though, right? So if they get to the top of the page and, the gaps are smaller and, margin of safety and stuff like that, we'll spin some down and we'll buy something that's lagging. And so our turnover ratio probably averages maybe 20% over the last 5 years. So, 5-year holding periods would be average, but our name turnover ratio, maybe 10%, so names are in there a long period of time, but the weights are changing based upon prices change. That's just, prices are nothing but odds. When the odds are changing, if the odds get to be more in our favor, we're going to add more to it. If the odds are at the top and the price is at the top and the odds are less for us, then we're going to take some money off the table. We're always just shaving odds. That's all we're doing.
And in terms of number of stocks, do you have a philosophy about that?
Yeah, we're 20 to 25, and a lot of that is because of fiduciary requirement. We're doing we have a lot of IRAs and stuff like that. 25 is a very focused portfolio. I mean, some people run 10 to 20. We try to run 20 to 25, and we've been as low as 20, and our max is 25. But that seems to be kind of a comfort zone for us, and we won't own a position greater than 10%. Once again, fiduciary responsibility. If it was my money, and all my money is in the same portfolio for my clients, if I didn't have clients, we wouldn't have sold NVIDIA twice last year when it went through 10%. We wouldn't have sold Amazon once last year when it went through 10%. Bill, when he owned Value Trust, I think Dell was 18% of the portfolio, going into the 90s. I mean, that was a great bet. I mean, the stock went up 8,000% during the decade of the 90s. And the smartest thing he did was not sell it, and so, but you have clients and they have IRAs and pension plans and stuff like that. So you got to be a little careful on their behalf that you don't give them too much volatility. I mean, we've got enough volatility in a 25 stock portfolio. You don't want to amp it by having 20% positions. But in a personal account, I think Charlie Munger said, he had 3 or 4 stocks, right before he passed. Let me ask you a question. Can I ask a question?
Yeah.
Okay. The tables are turned. Right now, I'm seeing everybody, including Vanguard, which will probably make Jack Bogle roll over in his grave, and BlackRock, American funds, right? Franklin Templeton, all of these guys are making partnerships with private equity firms to sell private equity investments to their retail clients. What do you think of that?
I think it's bullshit.
You and I are in agreement, although I won't use your word. I'll just say I think
we're all in agreement here.
Yeah. So take this picture with me. I had this discussion at Guy Spears conference in Omaha this year. I said, these guys are coming. It's very clear to me. I said, first of all, the endowment, the sovereign wealth funds aren't buying them anymore. They're to the gills. The endowments, they're starting to peel it off for various reasons. Family offices, they don't want it. They can't get most of the private equity sold. Nobody's buying it. So they set up these continuation funds. And right now they had the brilliant idea that there's just one last buyer that we haven't checked on. And that's, the 401k market and $10 trillion worth of investment. Why don't we go sell it to a bunch of individuals? And what's so disheartening, Amit, and is that these guys are saying, okay, come on in and you can invest our clients' money in private equity. When the track records are atrocious, they can't get it sold. The illiquidity premium that David Swenson so smartly took advantage of in the 1990s is gone. So what are they selling? I've been to one of these presentations. The first thing the guy said coming out to a room full of investors was, how many of you people hate the stock market and the volatility? Every hand went up. How many of you are sick of seeing the stock market go down 200 points one day, then up 200 points the next day, and then down 500 points the week after that? All the hands went up. He said, how would you like to have an investment that has no volatility? All the hands went up. He said, welcome to private equity. Not, is it better than investing in stocks? Not does it have a good track record. It's just they're, as Cliff Asness says, they're volatility washing. They're taking out what people hate the most, which is volatility, which is the challenge that we have in focused portfolios, which is if those 8 stocks that I told you, we looked at the performance behavior of those 10 stocks over time before that. And I will tell you, this was the 10-year record as of 2024. We'll do it at 2025 here shortly. On a month-to-month basis, we only outperformed of our portfolio 51% of the time, month to month. On quarterly returns, only 65%. So a third of the time we're underperforming. And on a yearly return, 70%. People don't like that. They like it when you outperform all the time. They don't want to be in a dry hole. They don't like it when something else is working and you don't own it. And that's the biggest challenge of this Buffett methodology. As Charlie Munger was saying, if what we do here at Berkshire is so smart and makes so much money, why aren't there other eminent places teaching it and practicing it? And the answer is the psychology of underperformance, the psychology of tracking error, the psychology of periodically underperforming the market with a concentrated low turnover portfolio is, that's what's going to happen. People can't handle it. But if you can find clients that do, boy, you've got a great life. If you can get that right fit of business owners that want to own great businesses, despite that they're publicly traded every single day. If you can get that connection, you're going to have a great business.
Yeah, we agree. That's what we learned that in the first few years. We had some limited partners who wanted to get a green month after month after month. And some of them one of them was my girlfriend's grandpa, who was kind of pressuring us to basically perform every month for his monthly report. And we just told him, like, the returns aren't going to be as good in the long term if we're focused on each month. So
yeah,
we
for sure.
let him go.
Yeah. I'll give you my last story. I know we're running out of time. So you might know the name Bill Ruane. He started the Sequoia Fund with Rick Knupp. He also was in the same